Bonds versus bond ETFs. The main difference between bonds and bond ETFs is how they're structured. Bonds purchase a specific debt security issued by a government, municipality, or corporation. Bond ETFs are structured like mutual funds but are traded on an exchange throughout the day. Diversification. Bond investors hold a specific bond issued by a single entity. Bond ETFs offer diversification by holding a portfolio of many different bonds. Liquidity. Bond liquidity depends on issuance size, credit rating, and prevailing market conditions. Bond ETFs provide intraday liquidity. This allows investors to buy or sell shares throughout the trading day. Income distribution. Bond investors typically receive semi-annual or annual interest payments directly from the bond issuer. Bond ETF investors typically receive monthly income distributions in the form of dividends. Dividends come from interest payments made by the bonds in the ETF's portfolio. Maturity. Bonds have a fixed target date at which they mature. Bond ETFs do not mature and attempt to maintain a weighted average maturity or duration. This means bond ETFs are continually buying or selling bonds to keep the ETF's maturity constant. Minimum investment. Purchasing individual bonds typically require larger initial investment, often in increments of the face value of the bond. Investors can buy shares of bond ETFs with a relatively small investment, as they are priced based on the market value of the ETF. Regular income. Bonds typically pay periodic interest payments. Capital preservation. The return of principal is a key feature of bonds, especially if held to maturity. Stability. During periods of market volatility, bonds often act as a safe haven asset. Bonds are typically lower risk investments and tend to attract investors seeking stability. Risk management. Different types of bonds carry different risk profiles. Carefully selecting bonds based on credit quality, maturity, interest rate risk, and other factors. Investors can customize their bond investments to manage risk in their portfolio. Tax advantages. Certain types of bonds, such as municipal bonds, may offer tax advantages. Interest income from municipal bonds is often exempt from federal income taxes, providing tax-efficient income. Interest rate risk. Bond prices are inversely related to interest rates. When interest rates rise, bond prices tend to fall, and vice versa. Credit risk. Risk that the issuer of a bond may fail to make interest payments or repay the principal at maturity. Liquidity risk. Some bonds, especially those with less frequent trading, may lack liquidity in the secondary market. Market risk. The bond market can be influenced by macroeconomic factors, geopolitical events, and changes in investor sentiment. Diversification. Bond ETFs provide instant diversification by holding a portfolio of bonds that can be diversified across risk, different issuers, maturities, and sectors. Liquidity. Bond ETFs provide investors with intraday liquidity. This allows you to buy or sell shares throughout the trading day. Accessibility. Bond ETFs can be bought and sold through brokerage accounts, making them accessible to a wide range of investors. Income generation. Bond ETFs typically produce regular distributions, often in the form of monthly dividends. Cost efficiency. Bond ETFs often have lower expense ratios compared to actively managed bond mutual funds. Interest rate risk. Like individual bonds, bond ETFs are subject to interest rate risk. When interest rates rise, bond prices typically fall, and this can lead to capital losses. Credit risk. If the ETF holds bonds with lower credit ratings, it may be exposed to higher credit risk. Defaults or downgrades of the underlying bonds can have an impact on the ETF's performance. Market risk. Bond ETF returns are influenced by market conditions, including interest rates and credit spreads. In certain market environments, such as rising interest rates or economic downturns, bond ETF returns may be affected. Price volatility. Bond ETFs are traded on stock exchanges, and their prices can be subject to intraday volatility. Investors may experience price fluctuations even if the value of the underlying bonds remains relatively stable. The bottom line: ultimately, the decision between individual bonds and bond ETFs depends on your individual preferences, investment strategy, and specific financial circumstances. While there are significant differences that investors should understand, bonds and bond ETFs share many of the same qualities, such as income generation and suitability for conservative strategies. Some investors may find a combination of both approaches to be appropriate for their overall fixed income allocation. Thanks for watching, and for more content like this, visit ETF.com.